Ladies and gentlemen, colleagues, welcome, and thank you for accommodating the changed schedule due to tomorrow being a public holiday. We greatly appreciate the fact that you've accommodated us. There are a number of key developments that this meeting of the Monetary Policy Committee had to consider, not least among them, on the domestic front, the challenge of moderate growth, rising inflation, a depreciated currency, a wider current account deficit, as well as difficult labour relations, while unemployment remains stubbornly high. Since the previous meeting of the MPC, the domestic inflation outlook has deteriorated somewhat. Risks posed by the depreciation of the Rand exchange rate have overshadowed the more favourable developments, including low electricity price increases and some moderation in food price inflation. Nevertheless, inflation is expected to remain contained within the target range, apart from a temporary breach in the third quarter of 2013. The domestic economic growth prospects remain fragile amid continued tensions in the labour market, particularly in the mining sector. The global economy is still characterised by a multi-speed recovery. However, recent events in Europe, particularly as they affect Cyprus, have increased risk and uncertainty in the region and have the potential to reignite the banking and sovereign debt crisis and undermine growth prospects further. The global outlook is also clouded by the fiscal gridlock in the United States that remains unresolved. The year-on-year inflation as measured by the Consumer Price Index for all urban areas was 5.9% in February 2013, up from 5.4% in January. The upside surprise in February was mainly due to the increase in medical insurance costs, which resulted in the contribution to CPI from miscellaneous goods and services increasing from 0.7 percentage points to 1.1 percentage points. This category also impacted on core inflation, which increased markedly from 4.7% in January to 5.3% in February. Petrol prices also contributed to the upward trend, having increased by 11.9%. Food price inflation measured 6.3%, down from a recent high of 7.5% in November 2012, and its contribution to overall inflation declined from 1 percentage points to 0.9 percentage points. Administered prices increased by 8.9% and by 7.5% excluding petrol. The Producer Price Index for final manufactured goods measured 5.8% in January. The inflation forecast of the bank reflects a slight deterioration in the inflation outlook for 2013 compared with the previous forecast. The forecast incorporates the new CPI weights and rebasing announced by Stats South Africa, as well as the low electricity price increase of 8% granted to Eskom by NERSA. Inflation is now expected to average 5.9% in 2013 and 5.3% in 2014, compared with the previous forecasts of 5.8 and 5.2% for these respective years. Inflation is expected to breach temporarily the upper end of the inflation target range in the third quarter of 2013, when it is expected to average 6.3%, and then to moderate gradually to 5.2% in the final quarter of 2014. This deterioration is largely due to the depreciation of the Rand and higher petrol prices, which more than offset the impact of the lower electricity price increases and a lower starting point. The forecast of core inflation is more or less unchanged for 2013, but higher for 2014, yet still indicates the continued absence of significant demand pressures. This measure is expected to peak at 5.1% in the second quarter of 2014 and to average 4.8% and 4.9% in 2013 and 2014 respectively. However, this forecast is likely to be adjusted upwards in the light of the increase in medical insurance costs announced earlier today. Inflation expectations, as reflected in the Reuters survey of analysts conducted in February 2013, have remained more or less unchanged since December. Expectations remained anchored within the target range, but close to the upper end, and, as with the bank's forecast, the peak is expected in the third quarter of 2013. The global economic outlook presents a mixed picture following a disappointing fourth quarter in most of the advanced economies. Recent data from the United States indicate positive trends in the labour market and household consumption expenditure, due in part to positive wealth effects from the housing and equity markets. However, Uncertainty about the possible negative impulse from fiscal tightening continues amid political differences over fiscal policy. Economic growth is still expected to remain below trend in 2013. The outlook for some of South Africa's other main advanced economy trading partners is less positive. The Eurozone remains in recession and is not expected to recover before mid-2013 at the earliest. The tail risks from a sovereign debt crisis appeared to have subsided, but the uncertainty created by the inconclusive Italian general election and the crisis in Cyprus has renewed concerns about the stability of the region. The outlook for the UK economy remains subdued against the background of continued fiscal austerity. Growth prospects in the Asian economies are more positive. The Japanese economy is expected to be bolstered by positive consumer sentiment in response to fiscal and monetary stimuli, but the response on the capital expenditure side is still cautious. Nevertheless, an improved growth performance is expected, particularly given the 18% depreciation of the yen against the US dollar since October 2012. Growth in China is expected to be sustained at relatively robust levels as fixed investment expenditure remains strong, despite a moderation in consumption expenditure growth. Growth in other emerging markets remain positive. These trends suggest that monetary policy in the advanced economies will remain accommodative for some time, despite recent fears in the financial markets of an early reversal of quantitative easing in the United States. The relatively weak growth outlook in the advanced economies has contributed to the subdued global inflation environment. The exchange rate of the rand continues to pose the main upside risk to the inflation outlook. Since the beginning of the year, the rand has depreciated by 8.4% against the US dollar and fluctuated within a range of 8.45 and 9.26. However, given the significant realignment of global currencies, and particularly the depreciation of the Japanese yen and the pound sterling against the US dollar, the trade-weighted depreciation since the beginning of the year was more moderate at 5.6%. Domestic factors contributing to the recent rand depreciation include continued work stoppages in parts of the mining sector, which also have the potential to disrupt electricity supplies, and the further widening of the deficit on the current account of the balance of payments, which measured 6.3% in 2012. Some narrowing of the deficit is expected during the course of the year in response to the depreciation, although the degree of response will be constrained by weak demand from advanced economies, as well as strong infrastructure-related import demands. Mining export growth will also be dependent on the resolution of labour market issues, with a resumption of full production, and on the extent of possible shaft closures. Equity and bond flows to emerging economies have generally moderated in the past few months, making for a more challenging global environment for financing the deficit. Inflows into South African bond and equity markets have, however, been sustained, and year-to-date non-resident net purchases of equities and government bonds have totaled 6.1 billion and 11.3 billion respectively. These flows have, however, been volatile, and the growing proportion of bonds owned by non-residents, currently around 37% of the total outstanding stock of debt, could constrain the pace of inflows. The rand is likely to remain sensitive to both domestic and global developments. The exchange rate is expected to remain volatile and subject to overshooting, and a further sustained depreciation would increase the upside risk to the inflation outlook. The Reuters Econometer survey conducted in February shows that most analysts still expect the rand to appreciate from current levels during the year, although the degree of dispersion is indicative of the uncertainty around these forecasts. According to the survey, the consensus forecast for the rand-dollar exchange rate at the end of 2013 is 8.61 rand, with a range of forecasts between 9.19 rand and 7.80 rand. Domestic growth prospects remain relatively subdued, notwithstanding a better-than-expected fourth-quarter GDP growth outcome and positive developments in the mining and manufacturing sectors in January. The economy grew by 2.5% in 2012, having recorded annualized growth of 2.1% in the fourth quarter, despite a 9.3% contraction in the mining sector. The moderate pace of recovery is expected to continue in 2013. The bank's forecast is for growth of 2.7% this year, marginally up from the previous forecast of 2.6%, and 3.7% for 2014, compared with the previous forecast of 3.8%. The risks to these forecasts are assessed to be on the downside. The flat trajectory of the bank's leading indicators of economic activity is consistent with this forecast. Growth this year is therefore expected to remain below potential output growth of 3.5%, and this is expected to result in a slight widening of the bank's revised estimate of the output gap, which at 2% reflects the continued subdued state of the economy. The mining sector recorded year-on-year growth of 7.3% in January, with 3-month-on-3-month growth of 5.4%, following 4 consecutive months of contraction. Nevertheless, the sector is expected to remain under pressure given the unsettled labour relations environment. The outlook for manufacturing appears to have improved, but this recovery is still very tentative. The sector grew at a year-on-year rate of 3.9% in January and by 1.8% on a 3-month-on-3-month basis. This was consistent with improvements in the Kagiso Purchasing Managers Index, which increased from 49.1 in January to 53.6 in February. Growth in gross fixed capital formation, which measured 5.7% in 2012, has been on a moderate upward trend since 2009, driven mainly by investment growth of around 9% by public corporations and general government. Private sector investment growth moderated from 4.6% in 2011 to 3.9% in 2012, due in part to excess capacity in manufacturing as well as electricity supply constraints. While household consumption expenditure has been the main driver of growth since 2010, its contribution to growth has been diminishing. The general absence of demand pressures in the economy is reflected in the continued moderation in the growth in real consumption expenditure by households, which grew by 3.5% in 2012 compared with 4.8% in 2011. Nevertheless, growth in consumption of durable goods remained robust at 11%, compared with demand for services which grew at only 1.8% in 2012. Sales of new motor vehicles declined on both a month-on-month and on a 3-month-on-3-month basis in February. Retail trade sales in January appear to reflect this weakening trend, with a 3-month-on-3-month decline of 0.7% and a lower than expected year-on-year increase of 1.9%. There are indications that consumption growth may moderate further in 2013 amid a slower real income growth, higher inflation, elevated household debt levels, and a possible slowdown in credit extension to consumers. 12-month growth in bank total loans and advances to the private sector measured 8.9% in January, following growth of 10% in December. Loans and advances to the corporate sector grew by 7.5% in January and to the household sector by 9.9%. Growth in general loans to households, mainly unsecured lending, moderated to 30.1% following a recent peak growth of 39.3% in June. General loans to households amounted to 8.3% of total loans and advances, and 14.6% of loans and advances to households. Growth in this category of lending is likely to be constrained by lower income growth and high household debt levels. Household debt to disposable income measured 75.8% in the final quarter of 2012. Non-mortgage debt as a percentage of total household debt increased from 37% in the third quarter of 2009 to 46% in the final quarter of 2012. The trend in wage settlements remains an upside risk to the inflation outlook, although recent data is somewhat contradictory. The minimum wage in the agricultural sector has been increased by 52.2%, and indications from the Andrew Levy employment publications are that wage settlements in collective bargaining agreements picked up significantly from 6.8% in the third quarter of 2012 to 8.2% in the fourth quarter. According to Stats South Africa, average salaries and wages per worker in the non-agricultural sector increased over 4 quarters by 7% in the final quarter of 2012, down from 8.9% in the previous quarter, while unit labour cost increases declined from 7.4% to 5.7% in the same period. The MPC remains concerned about the possible impact of excessively high wage increases on employment growth. Employment in the formal non-agricultural sector increased by 1% during 2012, compared with an annual employment growth of 1.6% in 2011. This included employment growth of 0.2% in the mining and quarrying industry and a 0.3% contraction in the manufacturing sector. In the fourth quarter of 2012, mining sector employment increased by 1,000 employees, following a decline of 16,000 in the third quarter. Of concern is the seasonally adjusted annualized decline of 0.7% in total non-agricultural employment during the fourth quarter of 2012. The recent national government budget tabled before Parliament reflects a difficult balance between a commitment to medium-term fiscal consolidation and the need for counter-cyclical policy. The projected deficit of 5.7% for the past fiscal year was wider than initially budgeted for, a result of lower revenue due to weaker economic growth. The fiscal deficit as a percentage of GDP is budgeted to be 5.1% in the 2013-14 fiscal year and to decline to 3.6% by 2015-16. The government net debt GDP ratio is expected to stabilize at around 40% in 2015-16, well below the international benchmark for debt sustainability of around 60%. There are indications that the pressures on inflation emanating from food prices may be moderating. Food price inflation at the consumer price level declined from a recent high of 7.5% in November 2012 to 6.4% in January and 6.3% in February. A similar trend is evident in the producer price level, where manufactured food inflation declined to 5.9% in January, compared with a recent peak of 11.1% in November 2012. Similarly, producer price inflation in agricultural products moderated from a recent high of 6.3% in October 2012 to 3.5% in January. Global agricultural commodity prices have declined on average by almost 20% since their peak in August 2012, and expectations are for further moderation in the absence of adverse weather shocks. Administered prices continue to put upside pressure on inflation. Although lower electricity price increases from the third quarter will serve to dampen this somewhat. The petrol price, which has increased by a cumulative R1.24 per litre since January 2013, remains an upside risk. Although global oil prices have declined over the past few weeks, resulting in an over-recovery of the petrol price so far this month, it is unlikely to be sufficient to offset the adverse exchange rate impacts and the fuel levy increases, and a further increase in the petrol price is likely in April. The MPC continues to assess the balance of risks to the inflation outlook to be on the upside, mainly due to the exchange rate and wage pressures. These upside risks are mitigated in part by lower risks from food price inflation. Underlying inflation appears to be relatively contained, consistent with the moderating trend in consumption expenditure by households. The economic growth outlook is more or less unchanged from the previous meeting of the MPC, and risks to the outlook remain on the downside. The unresolved labour disputes in the mining sector pose a significant risk to the exchange rate and to economic growth through their negative impact on export revenues, employment growth, and investor perceptions of South Africa. However, the depreciated exchange rate provides an opportunity for the manufacturing sector in particular to become more competitive despite the challenging export environment. Ensuring that this increase in competitiveness is sustained will require improved productivity and the containment of wage and other cost pressures, which underlines the need to keep inflation under control. The MPC continues to assess the monetary policy stance to be appropriately accommodative, given the persistence of the negative output gap. At the same time, further accommodation remains constrained by the upside risks to the inflation outlook. The MPC has therefore decided to keep the repo rate unchanged at 5% per annum. The committee will continue to apply monetary policy consistent with its mandate of price stability within a flexible inflation targeting environment. Thank you. Now open for any questions that you may have. Yes.
Good afternoon, Governor. I've got two related questions. You recently said that you thought the Rand's recent depreciation was overdone and it should retrace somewhat. Do you still hold this view? And I noticed that in the MPC statement you say that its latest depreciation is an opportunity for the manufacturing sector. Does this mean you're reasonably content with the current level of the exchange rate?
Perhaps let's deal with the first one. I think that our view is that it is the depreciation is somewhat overdone, and obviously its impact will depend on how long it stays where it is, if there's further depreciation, what that impact is, and the time taken to retrace. I mean, historically the Rand does tend to overshoot and then retrace. So I would hold with that view. As to whether we're satisfied with this level, we don't target a level of the exchange rate, and I think again we would emphasize that it's not simply the level that matters, it's also the volatility, the pace at which it depreciates, and the short period of time within which it responds. So in terms of this, what we're saying is that manufacturing has an opportunity with a depreciated currency to take advantage of that, notwithstanding the conditions in the global economy, to use the opportunity and to ensure that and we all have a responsibility to ensure that that competitiveness is maintained through the question of not allowing it to become a wage price spiral and so on. So it's not about whether we're satisfied with this level. What we're saying about the level, as I said, we don't target one, is that it's somewhat overdone, and we think that there is a question of retracing in a period of time. But this gives an opportunity for manufacturing and other sectors to look at their competitiveness and see what that allows in terms of, or affords them, in terms of the ability to export and obtain other markets. Yep.
Good afternoon, Governor. It's Renee Volgraf from Sunday Times. Governor, I would like to know, you mentioned that the bank expects inflation to average 6.3% in the third quarter.
No, what we said was that we expected to breach in the third quarter and reach 6.3, not to average.
Okay, so the highest point will be 6.3.
The average of, sorry? It will average 6.3 when it breaches at that level, yes.
So
but to retrace thereafter.
The average for the quarter is expected to be 6.3, or the highest point it will reach will be 6.3?
Is the average for that will be 6.3.
For the quarter. But what is the highest point that the bank expects inflation to reach if the average for the quarter is expected to be 6.3?
I don't know, Brian, if you've got something on that.
The bank's forecasting model is a quarterly model, so in terms of that core inflation, in terms of the core model forecast, we can't say exactly what it's likely to be and in which month. All we can say is that the model tells us that in the third quarter it will average 6.3, which means that it's likely for 1 or 2 months to be higher than that.
Frans?
Good afternoon, Governor. It's Franz Wild from Bloomberg. Just to clarify, you said the Rand is likely to retrace. Do you have an idea to what level it might retrace in your forecast and how soon that might happen?
No, we don't. All we're saying is that the Rand is driven, the depreciation of the currency is driven by a number of factors at this point in time. And the expectation is, if you look at historical patterns, the Rand is likely to retrace. To what level? As I said, we don't target a level. It depends on what the circumstances are. So it's not about a level or in what period of time. What we are also saying is that the longer it is depreciated, that would have a greater impact on inflation than if it moved and moved back fairly quickly. Let's just see first if there's anyone else. Yes?
Now I have two questions via the webcast from Garrett Brickman. His first question, has the MPC or would the MPC consider changing the repo rate in a denomination of less than 50 basis points, example 25 basis points? His second question, the 2013 government budget forecasts for the current account deficit to average at least 6 for the next 3 years. Does the MPC agree with this assessment? And if so, does it not point to a persistent vulnerability for the rand? Thank you.
I'll answer the first one. Perhaps who would like to deal with the second one? Brian? In terms of the amount, obviously, if you're looking at where the repo rate is now at 5%, it's very different from when you are at 11 or 12 or other percentages. So yes, we have said before, and we would repeat, depending on the circumstances and what we felt was appropriate, you do not only have to move in 50 basis point moves. The pattern has been, barring once, that it does move in 50 basis points, but the lower the repo rate is, the bigger the 50 basis point is in proportion. And therefore, yes, we could move in measures that would be smaller or bigger than the 50 basis points. Because obviously it would has a 25 basis point move on 5% is significant which would be much less significant if your repo rate was 10%. So yes, logically it does mean that we can move in measures different from 50 basis points. That doesn't mean to say we will. France.
Governor,
sorry, there was Brian's second part of the question.
Sorry.
Yeah.
Our forecast for the current account is slightly different to that of the Treasury. We do see the current account narrowing over the next couple of years, although not dramatically, and partly because the current account is constrained to the extent that we are importing a lot of capital equipment for the infrastructure development program. But that should be seen in a positive light, because that is those are imports that contribute to the efficiency of the economy and to enable us to export more in the future. The other factor in the current account also will be dependent on the extent to which there is a resumption of full capacity, or in the mining sector in particular, as we mentioned in the statement. That part of the widening on the deficit has been through a decline in the volume of mining exports related to the labour disputes, and hopefully that will also contribute to some narrowing over time.
I just want to check if there's anyone who hasn't asked a question, then I'll come back to you. Yes, sir.
Tsepo Mongwe, SABC Radio News. Governor, the unions have been pushing for a national wage, a national living wage, rather. I just want to get your thoughts on that. I think they're looking at something like just over 4,000 rand average worker. That should sort of be a benchmark. Your views on that as to how it would eventually affect inflation. And secondly, there's also a talk within unions that they're looking at bargaining using the actual rent value instead of a percentage. I just want to get your views on that.
I think it'd be difficult to comment on the latter, which is their bargaining tactics. I think it's up to them to look at what it is. Obviously, percentages are very different, and I think that they've stood the test of time, but that's up to them in the bargaining council with whoever their counterparty is to discuss what is appropriate. They've got to recognize that if they use rand values, or anyone does, they move up and down. So as long as you move on both directions, it would be something that you need to look at. In terms of a national living wage, I think that obviously this is part and parcel of what South Africa as a whole needs to consider. We've got an unemployment rate of over 25 or 24 point, just under 25% with the latest numbers, 24.9 I think it is. So, we can't be comfortable with that. And therefore the question of what is your national unemployment rate, what is your youth unemployment, the focus on all of these things. You want people to have a decent living wage, but you also want to ensure that it's affordable and sustainable. And our question that we raise here, we've raised before, is we need to look at what is in the immediate interest and what is the consequence. People have different jobs. We know that. So if you look at it in terms of having a national minimum wage that is going to result, and I'm not saying it will result, but I think what has to be taken account of is, do the demands result in less employment and movement to more capital-intensive or other means of getting the job done? And our challenge is the level of unemployment as well. So it's about the combination of issues. How do we ensure greater employment? How do we ensure greater productivity? How do we ensure better labor relations? How do we ensure that there's a much more informed and knowledgeable workforce and that employers come to the party as well? But you've got, in my view, what we have to take very real account of is trying to ensure that our unemployment rate drops. And inflation is certainly affected by what happens to wages and prices, and therefore these are issues that we have to take into account. The actual demands are something that would have to be determined in the bargaining process. But the consideration that we have is the impact on inflation, on employment, on growth, and on sustainability. I don't know if anyone wants to add anything to it. I think it was France, and then Miriam, and then Renee.
Governor, the inflation rate for February was 5.9% above expectations. To what extent does that factor into your, or how does that factor into your current inflation outlook? And following that, to the release of this morning's data, the market seems to have priced in a greater probability for a rate hike in the next year or so. Do you think that's a bit premature?
I think in relation to that, first of all, I think we need to bear in mind that the data came out a couple of hours ago, so we still have to analyze it in the detail. But what has obviously driven the difference, the unexpected part, we all knew we were expecting a petrol price increase and the impact of the petrol price. But what was, I think, the surprise in that is medical insurance, which has driven not only inflation but core inflation quite significantly. And we will then have to analyze that and look at what it does to our forecasts and what the implications of it are. Obviously, we haven't had the time to do that. And we would then weigh up what our choices are, because obviously it's one element, and we'll see what happens over the period of time. And we take the decision based on the information and looking forward as to what we expect. So I wouldn't comment now on what it would do to our approach going forward, other than to raise the concern that this again affects administered prices, and that is something that is obviously going to have quite an impact on core inflation and headline inflation, and we will examine it in the detail. Miriam?
Sorry, this is kind of rephrasing one of Franz's questions, but...
You're good at it. Keep going.
Thank you. You've repeatedly said that the MPC, that further accommodation is constrained by the upside risks to the inflation outlook. Is there, given that inflation is rising as rapidly as it is there any discussion in the MPC of possible rate hike in the medium term?
You have rephrased the question. I think that what we've said is that we look at, again, we operate within a flexible inflation targeting environment, which means that we look at what is the time horizon within which inflation should come back into the band of 3 to 6%. We've indicated that we expect the upper band to be breached for one quarter at 6.3% on average in the third quarter of this year. And part of the challenge of that is that we look at it, and if you looked at what we said here, and you can see it in the statement, that it will retrace itself over a period of time to end of 2014 at a more reasonable level. So in that sense, this is what we would take into account when we consider whether there is a need for raising rates. And we, again, I would emphasize, we don't only look at inflation. It's our primary responsibility. It is our core issue. But we look at the time horizon within which we feel it will retrace into the band. And if that appears to be reasonable, we would then, as we've said before, we've been fairly tolerant of inflation at the upper end of the band, given all the other factors that we take into account. Renee?
Thank you, Governor. I'm not going to be rephrasing any questions.
Good for you.
But I do want to ask a question that Miriam often asks at these press
Was it
conferences.
unanimous?
Yes.
Well, that's okay. That's a general question. I should put it in the statement and save a question for the future. Yes, it was unanimous. Again, I think that I want to emphasize that the point about unanimous doesn't mean that we simply sit there and say, okay, are we in favor of up or down or no movement? You've got a decision about whether you raise, whether you lower, or whether you hold. Whether you hold is equally a decision. It's not a default position. And our discussions, I think, are, and I would repeat that, are vigorous. They're thoughtful. There's a lot of discussion that takes place in the full preparatory discussion for the committee, where everybody does have a view and gives a view both on their own particular area, but more broadly. And therefore, we have a number of days of very intense discussion about it. When we come to take the decision, everyone gives a view that is very thoughtful, that has considered the issues. But so that when you come to an outcome which says this is unanimous, it isn't that, and when I say unanimous, it isn't the question that says, oh, you've said up, you've said down, you've said hold, and then we discuss to see what we can arrive at to make it unanimous. It's a question that everybody's position is that we felt right now, as in the past, that the best decision at this point in time is to hold rates where they are. So it's not like we're having to persuade somebody to become unanimous because we want unanimous. People should give a view, and if they have a differing view, we would listen to it very carefully. For all of us, there's a lot of that discussion that takes place. So we don't come to an easy conclusion. You may have the same conclusion, but it's not something that you arrive at easily from each person's perspective. There's a lot of weighing up what we have discussed. You want to follow up? If it's something else, then I want to go there first and I'll come back.
Okay, it's something else. I'll wait. Thanks.
Wait, yeah, thanks a lot. Yolanda.
Governor, a question from Rob Price. With regards to the expected benefits to manufacturers from the weaker rand, does the increasing cost of imported inputs not offset the short-term benefits of a weaker rand?
That implies that we're trying to get a weaker rand and we've manipulated it somewhere for one benefit or not. What we're saying here is that, yes, of course there's impact. We can see it on the oil price. You can see that you've got capital-intensive goods in terms of the infrastructure build program that we have that will be more expensive. So it's not whether one offsets the other. You're continuing with your infrastructure build because that is a key element of what we're doing to improve the economic efficiencies of this country and undo the blockages that are there, whether it is about rail transport, port efficiencies, and so on. That's happening. So yes, it does have an impact. And if you remember, which you may not recall quite a while ago, we had said is that when there was the argument about the rand being too strong, we said use that opportunity to import your capital goods because it gives you the advantage of a stronger currency. What we're saying here is they're not either-ors. There is the impact, there's no question, about a weaker currency, but there's also the opportunity if manufacturing takes advantage of the fact that it has a greater competitiveness and to maintain that competitiveness. So I don't think one looks at it as if this is a choice. We've designed this and there's only one direction. We fully understand that there's two sides to this equation, but it does present an opportunity for manufacturing in particular, and in terms of exports, to ensure that we get our goods to market. One of the challenges we've had over the recent period is the decline in exports, particularly in the mining sector. And that's partly due to what we've emphasized in the statement, the unsettled labor relations there, and we need to get our goods out of the ground and exported to be able to take advantage of the current environment around the rand. So yes, there are two sides to this equation. There's no question. Frans.
Governor, I have a follow-up to Renee's question.
Okay.
I wanted to know, how much time did you spend discussing a rate hike?
None. None. We didn't, you see, because the question is we don't sit and say, should we go up and by how much? And then, no, we don't really agree. We discuss the different elements of the issues. What is happening in growth? What is happening in inflation? What is happening in terms of exports? What's happening to the current account? That's what we discuss. So if somebody had wanted a rate hike, then they would say, I think that we should have a hike and I would like to do it for these reasons, and then we would discuss it. But we didn't. It was not an issue. So it's another way of asking the same question. Renee.
Thank you, Governor. I'll step off that now. I would like to know, in relation to your answer to Tsepo just now on the issue of unemployment, late last year, Ben Bernanke referred to the fact that he will keep rates accommodative and low until unemployment in the US reaches a certain level. I would like to know the MPC's view on that, especially since there has in the past been calls from unions that the MPC should play a role in helping to create employment by keeping interest rates lower, making it even lower.
Well, if there was a magic formula that said interest rates at this level will address all of our inhibitors to getting employment, as if that is the only equation, then the answer would be very simple. The Fed does have a dual mandate, which is both the question of employment and interest rates. But part of the challenge that we've got, if you looked at the period 2005, 6, 7 before the crisis, we were growing at 5+%. Unemployment at the start of that growth was around the levels that we're at now, around 25%. It fell to just below 22%. So that even if you're growing, you can address the question of unemployment to some degree. But that 22% is indicative of a structural problem. And you're not going to fix that structural problem by interest rates. If interest rates were the sole determinant of employment, if you looked at what is happening in terms of interest rates of the euro or of the UK, the interest rates are at all-time lows, as is, by the way, the Fed's, which is very low as well. And if you looked at the interest rates, yet unemployment in all of these areas is rising. Unemployment across the euro is 11.9, if I remember. It's just under 12. If you look at Spain, it's over 26. If you look at Greece, it's over 26. So that you've got, if the interest rate was simply the answer to creating employment, you've already got the very low interest rates. South Africa's real interest rates are already negative. So that it's not necessarily an interest rate problem. I think what we've got to recognize as a country is that there's not a magic formula that if you only did this, the problems would go away. There's a multiplicity of issues that need to be addressed in relation to employment. And it's part of it is growth. Growth is not the only answer. You can have growth, jobless growth. You've got to look at what it is that in combination needs to be done and by whom. That would help address our growth issues and inclusive growth, the question of creating jobs, and the question of sustainability within that. To look at it and think that it's an interest rate issue on its own is wishful thinking, in my view. And if it was so simple, I think we'd all be ready to do it. If you can guarantee that this is what would be, and we would reduce 25% unemployment to 15 or 10, or to come down to what would be a much greater challenge for us. I mean, you know, why should we even have those levels of unemployment? We've got to do things around education, around skills, around artisan training. There's a range of issues. That's it.
I must say, Renee, that Bernanke didn't end where you ended. He also said that they stand ready to act should they get any indication that inflation is going to breach their target over the medium term. So it didn't end there. And I must also state here that the developed countries at the moment are facing a different problem. In particular, the US is facing a different problem. Their problem is not that inflation is rising. Their problem is that they have got too little inflation. So they are trying to reflate their economies. So I thought that putting that context is going to be very important.
Any other questions? Yolanda?
Governor, question from Peter Montalto. What are the triggers you are looking at around Europe? Is it possible that the downside risks to growth from Europe can intensify enough from Cyprus and Italy that a rate cut is possible, or are the inflation risks simply too great even to consider that?
I think, Peter, welcome. Nice to hear from you as well, and perhaps other colleagues would also like to respond to Peter. I will deal with one aspect of this, because I think the triggers of Europe, I mean, they have so many. It's quite hard to think that you are coming out. It appeared to have been settled to some degree and beginning to normalize, and then, you know, something like Cyprus happens. I don't think that one should focus simply on Cyprus. I think the issues around Cyprus are much bigger. It's about what have we done with regulatory reform. You've created a situation around deposit insurance, a confidence around, don't forget, this crisis started with subprime and moved into a systemic banking crisis. So to me, the challenge of what has occurred around Cyprus is that the very measures that have been put in place around trying to address the systemic banking issues, especially around deposit insurance across the Eurozone, has been done away with or nullified in one fell swoop, where finance ministers have simply said they can take people's savings in another country. Well, I think we'll wait and see when they open the banks tomorrow what happens, and I hope that it does stabilize. So I don't think that's a trigger in relation that one would have. I think it is the way the crisis mutates and how we, in that process, unintended consequences or things that have not been properly thought out impact. So I think it's very different from Italy. Italy is basically a country without a government. And we'll have to see what happens in terms of what the next steps as to whether they are going to have another election or what is going to occur. And I think it is a huge challenge for Italy. I was fortunate to be there a couple of weeks ago, and it was very interesting to listen to the Italian business community asking questions about how you run a country without a government and saying, well, Brussels seemed to do it, but we're not Brussels. So it was a very interesting question, and I think it is a challenge for Europe and certainly for Italy, and we'll see where that goes to. But I don't think that, you know, those are triggers that we would look for. I think the challenge for us around a cut relates to our own domestic conditions, and obviously the domestic conditions are impacted and influenced by what happens in Europe. I think that we are, as we've said repeatedly, very concerned about Europe and its impact. But we do see that perhaps the US is able to lead a little bit out of that crisis. Japan, we'll have to see what happens. But a very difficult environment, and we will weigh up the conditions in terms of our decision as and when we look at them next time. Anyone else? Would you like to say anything that you feel we need to address? Anybody? Okay. Everyone, thank you very much. Thanks for being here today, and thanks for your questions and contribution, and we look forward to seeing you at the next meeting.